Most tax preparers believe an EFIN is simply a permission slip. You apply for it, you get approved, and as long as you do not intentionally commit fraud, you assume it will remain active. That belief is incorrect. To the IRS, an EFIN is not a reward or a badge. It is an access credential. It allows you into a regulated system that handles federal taxpayer data, refunds, credits, and identity verification. The moment your behavior suggests that access creates risk, the IRS can restrict or revoke it. The IRS does not treat EFINs emotionally. They treat them analytically. Every return you file contributes to a profile. That profile is not about one client, one mistake, or 1 year. It is about patterns, consistency, documentation, behavior. When the IRS evaluates EFIN activity, they are asking a simple question. Does this preparer increase or reduce compliance risk? Many EFIN revocations happen quietly because the IRS does not need a public scandal to act. They do not need to prove criminal intent to protect the system. Administrative authority allows them to suspend or revoke an EFIN if continued participation poses a concern. That is why many preparers are shocked when they receive letters stating their EFIN has been deactivated, even though they believe they did nothing wrong. Understanding how the IRS views your EFIN is the foundation for protecting it. The rest of this video breaks down exactly what triggers scrutiny, how revocations really happen, and why so many preparers never see it coming. EFIN revocation rarely starts with a dramatic accusation. It usually begins with data. The IRS continuously reviews preparer activity through automated systems. These systems compare your filings to national, regional, and peer benchmarks. When numbers fall outside expected ranges, flags are generated. Those flags do not accuse you of wrongdoing. They simply indicate elevated risk. The problem is that preparers often assume silence means approval. If no letter arrives, no audit occurs, and refunds continue processing, they believe everything is fine. In reality, the IRS does not operate on immediate confrontation. They observe, they track, they document. By the time a preparer receives formal notice, the decision may already be well supported internally. Another reason revocations feel sudden is because preparers underestimate administrative authority. The IRS does not need to prosecute you to remove your EFIN. This is not a criminal proceeding. It is a compliance determination. If they believe your practices fail to meet standards, they can restrict your ability to file regardless of intent. This creates a dangerous gap between perception and reality. Preparers believe revocation only happens to scammers. The IRS revokes EFINs for consistent negligence, failure to document, poor record keeping, ignoring correspondence, or patterns that suggest a lack of due diligence. None of these require malicious intent. They require repeated risk. One of the most damaging misunderstandings in the tax industry is confusing fraud with compliance failure. Fraud requires intent. Compliance failure does not. EFIN revocations are usually tied to compliance failure, not fraud. Compliance failure includes things like not retaining required documentation, failing to ask reasonable questions, relying on verbal client statements without verification, or repeatedly submitting returns that result in adjustments. These actions may feel minor individually, but collectively, they create a profile of risk. The IRS operates on the assumption that licensed or authorized preparers understand their obligations. "I didn't know" is not considered a valid defense once you are granted filing authority. The expectation is that you understand filing standards, documentation requirements, and due diligence rules from the moment you begin. The IRS does not evaluate returns one by one in isolation. They analyze patterns across time. They compare your activity to similar preparers. They track consistency, accuracy, and outcomes. Key data points include frequency of certain credits, refund to income ratios, error rates, amendment frequency, documentation compliance, response behavior to IRS correspondence. If your data consistently deviates from expected norms, your profile accumulates risk markers. 1 or 2 flags may mean nothing. Repeated flags across seasons signal systemic issues. Importantly, the IRS does not need to believe you are dishonest. They only need to believe your process creates risk. If your profile suggests that improper returns are more likely under your EFIN than others, intervention becomes likely. This process is quiet, automated, and ongoing. There is no warning light that turns on. Preparers only become aware when corrective action is requested or filing privileges are limited. Due diligence failures are one of the fastest paths to EFIN revocation. Form 8867 is not paperwork for the sake of compliance. It is evidence that you met your responsibility to ask, verify, and document. Failing to complete Form 8867 correctly, failing to retain it, or failing to support the information reported on it signals a lack of procedural control. The IRS views this as a systemic issue, not a single oversight. What many preparers do not realize is that the IRS does not need to find false information on the return to penalize due diligence failures. The absence of documentation alone is sufficient. If you cannot demonstrate how you verified eligibility, the IRS assumes the process did not occur. Repeated due diligence penalties escalate quickly. They create a documented record that your EFIN is associated with noncompliance. This is one of the clearest administrative justifications for revocation. Documentation is not about protecting yourself emotionally. It is about meeting an evidentiary standard. The IRS expects preparers to retain records that show how decisions were made, what questions were asked, and what proof was reviewed. Verbal statements from clients are not documentation. Notes without supporting records are weak evidence. Consistent reliance on unverifiable information increases risk. When the IRS reviews preparer activity, they are not asking whether the return made sense. They are asking whether it can be defended using retained records. If documentation is missing, incomplete, or inconsistent, the presumption shifts against the preparer. This is where many EFINs are lost, not because returns were wildly inaccurate, but because preparers could not demonstrate a reliable process. One of the most underestimated risks to an EFIN is failing to properly respond to IRS correspondence. Many preparers assume that IRS letters are informational, optional, or client-facing. In reality, when the IRS sends correspondence connected to preparer activity, it becomes part of a documented compliance trail. Each letter is logged, tracked, and associated with your EFIN. Ignoring a letter does not make the issue disappear. It escalates it. From the IRS perspective, a lack of response suggests one of three things. The preparer does not understand the issue, the preparer does not have adequate records to respond, or the preparer is unwilling to correct behavior. None of those interpretations work in the preparer's favor. Even when a letter is not accusatory, it often serves as an early warning. It may request clarification, documentation, or corrective action. When no response is received, the IRS assumes future compliance is unlikely. This assumption significantly increases the probability of administrative action, including suspension or revocation of filing privileges. Timeliness matters. A late response is better than no response, but repeated delays signal poor internal controls. Completeness also matters. Partial answers or vague explanations suggest a lack of documentation or process. Many preparers lose their EFIN, not because of the original issue referenced in the letter, but because the IRS concludes that the preparer is disengaged from compliance responsibilities. In the IRS system, silence is not neutral. It is interpreted as risk. The IRS clearly distinguishes between isolated errors and recurring issues. A single mistake, even a significant one, does not usually define a preparer. Pattern errors, however, signal a systemic problem. They suggest that errors are not being identified, corrected, or prevented within the preparer's process. Pattern errors occur when the same type of issue appears across multiple returns, clients, or tax years. This may include repeated misapplication of eligibility rules, recurring documentation gaps, or consistent misreporting of certain items. When these patterns appear, the IRS assumes the issue is not accidental. From the IRS perspective, patterns indicate that the preparer's internal controls are insufficient. The assumption is that if the preparer were exercising appropriate diligence, the issue would have been corrected after the first occurrence. When it continues, the problem is no longer the mistake itself, but the failure to address it. This is why preparers are often surprised by enforcement actions. They remember correcting individual returns when issues were identified. The IRS, however, sees the broader picture. They see how long the pattern persisted, how many returns were affected, and whether corrective steps were documented. EFIN revocations are far more likely to result from repeated moderate issues than from one extreme error. Consistency matters. Repetition matters. The absence of internal correction mechanisms is a major red flag. Returns that result in refunds are not inherently problematic. However, preparers whose filings consistently produce high refunds attract additional scrutiny simply because of the financial impact. Refunds represent money leaving the Treasury, and the IRS monitors refund patterns closely. When refund-focused profiles are combined with other risk factors, such as documentation weaknesses or due diligence penalties, the level of concern increases substantially. The IRS begins to question whether eligibility standards are being applied conservatively and consistently. High refund ratios compared to similar preparers can position an EFIN as a statistical outlier. Outliers are reviewed more often. This does not mean the refunds are incorrect, but it does mean the preparer must be able to clearly support them. The risk escalates when preparers focus primarily on outcomes rather than process. If returns consistently generate favorable results without strong supporting documentation, the IRS may conclude that verification standards are not being met. Preparers sometimes believe that as long as clients qualify, the refund size should not matter. The IRS, however, evaluates both qualification and verification. Large refunds without documented diligence raise questions about how eligibility was established. Maintaining an EFIN requires understanding that refund outcomes are part of a larger risk assessment. Consistent results must be defensible, repeatable, and supported by records. One of the most common misconceptions among preparers is that responsibility transfers to the client when incorrect information is provided. From the IRS standpoint, this is incorrect. Preparers are expected to exercise professional judgment and not rely solely on client statements when those statements appear inconsistent, incomplete, or implausible. The IRS expects preparers to ask reasonable follow-up questions. If information provided by the client triggers uncertainty, clarification is required. Accepting questionable information without inquiry is viewed as a failure of due diligence. This standard applies even when the client insists the information is accurate. The preparer's obligation is not to accept information at face value, but to evaluate whether it aligns with known rules and facts. When incorrect information is later discovered, the IRS examines whether the preparer had reason to question it at the time of filing. If red flags were present and ignored, liability does not disappear simply because the client was dishonest. Many preparers feel unfairly blamed in these situations. However, the IRS position is consistent. Preparers are gatekeepers. They are expected to prevent improper filings, not merely transmit information. Repeated reliance on client statements without verification is one of the clearest indicators of compliance weakness. Over time, this behavior significantly increases the likelihood of EFIN enforcement. Record retention is a core compliance requirement, not an administrative preference. The IRS requires preparers to retain specific records for a defined period, and failure to do so constitutes a violation regardless of intent. When records are missing, incomplete, or inaccessible, the IRS assumes that required procedures may not have been followed. Poor organization, lost files, or reliance on memory are not acceptable explanations. The ability to produce records upon request is critical. If documentation cannot be retrieved promptly, the IRS may conclude that the preparer lacks adequate internal controls. This conclusion affects EFIN eligibility directly. Record retention failures often surface during reviews or correspondence. When the IRS requests documentation and it cannot be provided, the issue escalates quickly. What may have started as a routine inquiry becomes a compliance concern. Tax rules and compliance standards evolve regularly. The IRS expects preparers to stay informed and adjust their practices accordingly. Continued application of outdated rules signals professional negligence, not oversight. When guidance is issued publicly, the IRS assumes preparers are aware of it. Errors that occur after clarification has been provided are treated more seriously than those that occurred before. This is particularly relevant for due diligence standards, eligibility criteria, and documentation requirements. Applying last year's rules to current filings increases risk significantly. The IRS evaluates whether errors persist after guidance changes. If they do, the assumption is that the preparer is not monitoring updates or is unwilling to modify processes. In EFIN evaluations, failure to adapt is viewed as a structural weakness. It suggests that future compliance issues are likely, even if current errors are corrected. Preparers who consistently update their practices reduce risk. Those who rely on outdated knowledge increase it. EFIN protection depends on responsiveness to change. The IRS evaluates preparers in context. Each EFIN is compared to others with similar volume, geography, and client profiles. These peer comparisons help identify outliers. Outliers are not automatically wrong. However, they receive additional attention. If a preparer's outcomes consistently differ from peers, the IRS investigates why. Peer comparisons consider error rates, adjustment frequency, and return characteristics. When deviations are unexplained or unsupported, risk increases. Many preparers assume they are evaluated independently. In reality, comparative analysis is a central enforcement tool. Standing out statistically without strong documentation invites scrutiny. Maintaining an EFIN requires understanding that compliance is relative as well as absolute. Many preparers misunderstand the difference between an administrative suspension and a full EFIN revocation, and that misunderstanding often leads to poor decision-making when IRS notices arrive. These two actions may sound similar, but they carry very different consequences and timelines. An administrative suspension is typically temporary. It is often issued when the IRS identifies compliance concerns that require correction before filing privileges can continue. Suspensions may be tied to unresolved correspondence, incomplete documentation, failure to respond to inquiries, or pending verification issues. In these cases, the IRS is signaling that risk has been identified, but remediation may still be possible. EFIN revocation, however, is far more serious. Revocation removes electronic filing privileges entirely and reflects the IRS's conclusion that the preparer or firm presents an unacceptable compliance risk. This decision is not made lightly. It usually follows documented patterns of noncompliance, unresolved due diligence failures, or repeated administrative issues that were not corrected after notice. Once revoked, reinstatement is not automatic. The IRS may require a waiting period, additional verification, or may deny reapplication altogether. Prior compliance history heavily influences these decisions. A critical mistake preparers make is treating suspension notices casually, assuming they will resolve themselves. From the IRS perspective, suspension is often the final opportunity to demonstrate corrective action. Failure to respond appropriately accelerates escalation. Understanding this distinction matters because it shapes how preparers should respond. Suspension requires immediate engagement. Revocation often reflects that engagement never occurred. EFIN eligibility is not based solely on numerical accuracy. The IRS evaluates professional conduct as part of its broader risk assessment. How a preparer behaves, communicates, and responds to compliance obligations influences whether the IRS views that preparer as trustworthy. Professional conduct includes honesty in representations, transparency with clients, responsiveness to IRS correspondence, and adherence to ethical standards. These factors are monitored through complaints, correspondence history, and internal review processes. Ethical lapses do not need to rise to the level of fraud to matter. Misleading explanations, careless documentation practices, or dismissive responses to IRS inquiries all suggest poor professional judgment. Over time, these behaviors contribute to a risk profile that may justify enforcement action. The IRS expects preparers to act as professionals, not just processors. This includes recognizing when information appears inconsistent, correcting errors proactively, and maintaining respectful communication. Preparers sometimes underestimate how much tone and behavior influence outcomes. A cooperative, thorough response to an IRS inquiry often mitigates concerns. A defensive or incomplete response escalates them. Ethics matter because they reflect how a preparer is likely to behave in future situations. The IRS's goal is not to punish past behavior, but to prevent future risk. Professional conduct provides insight into that likelihood. New preparers often feel targeted when IRS scrutiny occurs early in their careers. In reality, heightened monitoring is a standard risk management practice. Inexperience correlates strongly with procedural errors, documentation gaps, and misunderstanding of due diligence requirements. The IRS evaluates early filing patterns carefully because those patterns tend to persist. Errors made during the first filing seasons often establish habits that continue unless corrected. From a compliance standpoint, early intervention reduces long-term risk. New preparers are also less likely to recognize warning signs or understand the importance of record retention. This increases the likelihood that issues go unaddressed. Importantly, increased scrutiny does not imply wrongdoing. It reflects uncertainty. The IRS simply does not yet have enough data to determine whether the preparer's practices are reliable. This is why early compliance discipline matters. Establishing strong documentation habits, responding promptly to correspondence, and correcting errors quickly can significantly improve a preparer's long-term profile. New preparers who ignore early issues often face escalating consequences later. Those who address them proactively reduce risk substantially. Understanding this dynamic allows new preparers to operate strategically rather than defensively. Early diligence protects future filing privileges. EFIN revocation decisions are administrative, structured, and data-driven. They are not based on isolated incidents or subjective opinions. By the time revocation is issued, multiple indicators have already aligned. The IRS evaluates filing patterns, correspondence history, documentation adequacy, responsiveness, and prior enforcement actions. These data points are reviewed collectively, not individually. Revocation typically follows a progression: initial concerns, correspondence, opportunity for correction, continued non-compliance, and finally enforcement. Preparers often focus on the final notice, but the decision is shaped long before that point. Internal reviews involve multiple levels. This ensures consistency and reduces the likelihood of arbitrary action. However, it also means that once revocation is initiated, reversal is difficult. Appeal rights may exist, but they are limited in scope and time sensitive. Appeals focus on procedural errors, not disagreement with IRS conclusions. Understanding how decisions are made helps preparers recognize warning signs earlier. Revocation is rarely sudden, it is usually the result of unresolved patterns. Losing an EFIN has consequences that extend far beyond a single tax season. Electronic filing privileges are foundational to modern tax preparation. Without them, business operations are severely constrained. Revenue loss is immediate, client trust is damaged, professional reputation suffers, future approvals become more difficult, reapplication is not guaranteed, prior revocation becomes part of the preparer's permanent compliance history. This history is reviewed in future applications and related approvals. Even preparers who regain filing privileges often face ongoing monitoring. The recovery process is long and uncertain. The impact is not only financial, career trajectory changes, opportunities narrow, partnerships become harder to secure. Understanding these consequences reinforces why proactive compliance matters. EFIN protection is not about avoiding penalties. It is about preserving long-term professional viability. EFIN protection is achieved through proactive compliance, not reactive explanations. Waiting for IRS contact before addressing issues increases risk significantly. Proactive compliance includes consistent documentation, regular internal reviews, prompt responses to correspondence, and adaptation to regulatory changes. The IRS evaluates whether a preparer has systems in place to prevent errors. Correcting mistakes after detection is expected, but preventing them demonstrates maturity. Preparers who view compliance as an ongoing process experience fewer enforcement actions. Those who treat it as an afterthought face escalating risk. EFIN protection requires discipline. It is built over time through consistent behavior. An EFIN represents conditional trust. It is granted based on the IRS's assessment of risk, not entitlement. Maintaining that trust requires understanding how the IRS evaluates preparers. Intentions matter less than patterns. Effort matters less than outcomes supported by documentation. Preparers who align their practices with IRS expectations protect their filing privileges. Those who rely on assumptions expose themselves to enforcement. EFIN responsibility is ongoing. It requires vigilance, professionalism, and respect for the role preparers play in the tax system. Those who understand this operate differently and remain compliant longer.